On the morning of January 30th, 2026, silver didn't just fall, it collapsed. One moment it was sitting proudly above $120 an ounce. Hours later, it was drowning near $70. Over $50 vanished in a single session. Not a correction, not a dip, but a financial freefall. Traders stared at their screens in disbelief. Margin calls detonated across the globe. Dealers from Dubai to Switzerland ran out of physical silver entirely. And while the world panicked, one unknown trader sat quietly on the other side of the market, already winning. The silver crash of 2026 wasn't supposed to happen. Not like this. Markets move up and down, sure, but silver dropping over 30% in one trading day is the kind of event analysts label statistically impossible. A Six Sigma shock, the type of collapse that should occur once in several lifetimes. Yet it happened. In less than 48 hours, trillions evaporated from global asset markets. Retail traders were wiped out instantly. Hedge funds scrambled to cover positions. Brokers forced liquidations at record speed. It was financial chaos unfolding in real time. But here's the part that made no sense. Gold fell too, but only slightly. Silver, however, was obliterated. If this was simply about a stronger dollar or interest rate expectations, why did silver crash 3 times harder than gold? Both metals trade in dollars. Both respond to macro pressure. Both are considered safe haven assets. So why did silver behave like a meme stock in a meltdown while gold barely flinched? That imbalance is the real mystery. Mainstream media rushed out easy explanations. New Fed nomination. Markets fear higher rates. Precious metals sell off. But those headlines covered maybe 10% of what truly happened. Because underneath the surface, something much darker was unfolding. A brutal chain reaction of leverage, forced selling, margin hikes, and coordinated short pressure. Silver wasn't collapsing because people suddenly stopped valuing it. Silver collapsed because the paper market was rigged like a tower of explosives. And someone lit the match. And while millions watched their accounts burn, one trader was positioned perfectly to profit. One man, one massive short bet. And his trade may have exposed a crack in the silver market so deep it could reshape precious metals forever. At first, it looked like a normal panic event. President Trump nominated Kevin Warsh as the next Federal Reserve Chair. Warsh was viewed as a hawk, someone who would keep interest rates higher for longer. The dollar surged, metals dropped, and the story seemed complete. Case closed. Except it wasn't. Because silver didn't just drop, it imploded. And that kind of move doesn't happen without structural weakness. Positioning data showed something terrifying. And speculators were loaded with record-long silver exposure heading into that week. The market was leaning one direction harder than at almost any point in history. Silver had become a crowded trade. Then the trigger hit. ETF selling exploded. One major silver trust alone dumped billions worth of exposure in a single day. And just as panic accelerated, the CME raised margin requirements. Right in the middle of the crash. That decision was gasoline on a fire. When margins rise during a sell-off, leveraged traders are forced to liquidate instantly. Their positions are sold into weakness, pushing prices lower, triggering more margin calls. A cascading death spiral. And in that exact moment, someone was waiting. A trader holding the largest silver short position on the planet. 30,000 contracts. Hundreds of tons worth of exposure. While the world screamed, he stayed calm. Because he wasn't losing, he was collecting. Bloomberg later estimated his gains near $288 million, with net profit around $144 million, even after earlier losses. But this story isn't just about one mysterious billionaire making money. Because while silver futures were collapsing in New York, physical silver was doing the opposite. Dubai had none. Switzerland was sold out. Japan was trading silver at a 50% premium. And Shanghai? Shanghai was still pricing silver above $100. Same metal, same day. Two completely different realities. Paper said silver was cheap. Physical market said silver was unavailable at any price. That divergence should not exist in a functioning global commodity system. Unless the pricing mechanism itself is breaking. And what happened on February 5th, a trading volume shock out of Shanghai, may be the single most important clue in the entire silver market today. Silver's rise before the crash was nothing short of historic. For most of 2025, the metal behaved like it was entering a once-in-a-generation supercycle. In early January, silver was still trading around the $30 range. By the time the calendar flipped toward 2026, it had surged beyond $120 an ounce, a 4 times rally in less than a year. That kind of move doesn't just attract attention, it attracts obsession. Traders, hedge funds, retail investors, and even industrial buyers all rushed toward the same conclusion. Silver was becoming the most important metal in the world again. And on the surface, the narrative made sense. Solar panels require silver, electric vehicles require silver, advanced electronics require silver. Artificial intelligence infrastructure, medical devices, high-tech manufacturing, all of it depends on silver's unmatched conductivity. Unlike gold, which is mostly stored, silver is consumed. It disappears into products, never to return. Supply was already tight, demand was accelerating, and the world began to feel like it was running out. But markets don't move in straight lines. When something rises too fast, it creates hidden fragility underneath. Every parabolic rally builds leverage like pressure inside a sealed container. Futures traders borrow against their positions. ETFs rebalance exposure using derivatives. Speculators pile in with borrowed money, convinced the trend cannot break. And eventually, the entire structure becomes a ticking time bomb. The price is no longer just reflecting demand, it is reflecting positioning. By late January 2026, silver had become one of the most crowded trades on Earth. Positioning data showed speculative net long exposure near record highs. Everyone was leaning in the same direction. The market was stretched tighter than at almost any point in history. That kind of imbalance is dangerous because when the trigger arrives, there is no one left to buy, only sellers scrambling for the exit. Then, on January 30th, the trigger hit. News broke that President Trump had nominated Kevin Warsh as the next Federal Reserve Chair. Warsh was viewed as a monetary hawk, someone likely to keep interest rates higher for longer. The dollar surged. Precious metals immediately sold off. Gold dropped, but silver collapsed. At first, traders assumed it was a normal reaction to macro headlines, but within hours, it became obvious this was something far bigger. Silver didn't decline gradually. It fell off a cliff. What followed was not a simple correction. It was a liquidation cascade. ETFs were forced to dump exposure. Analysts later estimated that one major silver trust alone saw billions in forced selling in a single session. And just as the market was already cracking, the futures exchange raised margin requirements. That decision poured gasoline on the fire. When margins rise during a crash, leveraged traders are forced into impossible choices. Either they deposit more capital immediately, or their positions are liquidated automatically. Most cannot meet the new requirements in time. So their contracts are sold into a falling market, pushing prices lower, triggering more margin calls, forcing more liquidations. It becomes a self-reinforcing spiral, a mechanical death loop that has nothing to do with silver's real-world value. This is how silver went from $121 to nearly $70 in hours. Across the globe, retail traders were wiped out instantly. Accounts were liquidated in real time. Funds scrambled to cover losses. The financial media called it a statistical impossibility, a Six Sigma event, the worst single-day collapse since 1980. Trillions evaporated from markets in less than 2 days. But while the world panicked, someone else remained calm. Because someone had been waiting for this exact moment. On the other side of the crash sat a trader holding the largest silver short position on the planet. 30,000 contracts. Hundreds of tons worth of exposure. A bet so massive it dwarfed almost everyone else in the market. And as silver collapsed, his profits exploded. That man was Bian Shiming, a Chinese metals billionaire known for making billions betting correctly on gold through the Shanghai Futures Exchange. He wasn't a random speculator. He was one of the sharpest commodity traders alive. Reports suggested he began building short exposure months earlier, starting in late 2025. He took losses at first, attempting to catch the top too early, but he persisted. And when silver finally peaked, he pressed harder. By January 30th, as silver hit record highs in Shanghai, he added aggressively, increasing his position by thousands of contracts right at the peak. When the crash arrived, Bloomberg estimated his gains near $288 million with net profit around $144 million, even after earlier setbacks. Yet the most unsettling part of the story is not that one trader made money. The unsettling part is what happened in the physical market. Because while paper futures in New York were collapsing towards $75, physical silver around the world was doing the opposite. Dealers in Dubai reported empty shelves. Switzerland saw inventory vanish. Japan priced the same ounce of silver far above Western markets. Shanghai continued trading at premiums that made no sense. In a functioning global commodity market, such spreads cannot last. Arbitrage traders should buy cheap silver in New York, ship it to Asia, and close the gap. But that mechanism failed. Borrowing costs surged. Lease rates jumped to levels that killed profitability. Freight and insurance made transport uneconomic. The system designed to keep prices aligned was breaking down. Silver was cheap on paper, but unavailable in reality. And that contradiction is what makes the January crash so important. The paper market was screaming collapse, but the physical market was whispering scarcity. The futures price said silver was abundant. The real-world supply chain said silver was disappearing. The crash exposed something deeper than volatility. It revealed that silver ES pricing mechanism may no longer reflect the true balance of supply and demand. The world watched silver fall $51 in a day, but underneath, the metal itself was becoming harder to find. And that is why the story isn't over. Because if paper selling can crush the price short term, but physical shortages continue growing, then the next phase of this market could be even more explosive. Silver may have collapsed in January, but the forces driving its scarcity never left. They only became clearer. So what does all of this actually mean? It means the January 30th silver crash was not the end of the silver story. It was the exposure of something far bigger. Because if you only look at the headline price chart, it seems simple. Silver went parabolic, then it broke. Bubble popped. Traders got wiped out. Move on. But that explanation is shallow. And what really happened was not a fundamental collapse. It was a leverage collapse. Silver didn't crash because the world suddenly stopped needing it. Silver crashed because too many traders were positioned the same way, using too much borrowed money inside a market built on paper claims rather than physical reality. That distinction matters. A fundamental crash happens when demand disappears or supply overwhelms the market. A leverage crash happens when positioning becomes unstable and the system forces liquidation. The price moves not because the asset has changed, but because traders are being mechanically pushed out. And every piece of evidence points to January 30th being exactly that. A forced purge. Look at what happened afterward. If silver truly collapsed in value, the physical market should have followed. Dealers should have been flooded with supply. Premiums should have vanished. Inventory should have surged. Instead, the opposite occurred. Dubai ran out, Switzerland sold out, Japan priced silver dramatically higher. Shanghai continued trading at a massive premium. So ask yourself, how can an asset be crashing on paper while becoming impossible to buy in real life? That contradiction is the fracture. Because the silver market is not one market. It is two markets. There is the paper silver market, futures contracts, ETFs, leveraged speculation. This is where the price is set on screens. And then there's the physical silver market, real bars, industrial supply chains, actual delivery. When those two markets diverge, something breaks. And right now, the divergence is extreme. Some analysts estimate the paper-to-physical ratio on major exchanges near 300 or even 350 to 1. That means for every ounce of silver that exists, there are hundreds of paper claims trading against it. Hundreds. That system works only as long as most people never demand delivery at the same time. It works as long as the paper market remains trusted. But what happens when trust collapses? That is what January 30th hinted at, and it gets even more serious when you zoom out to the structural forces underneath. China has reclassified silver as a strategic resource. Industrial demand is accelerating faster than supply can respond. Mining projects take nearly a decade to come online. Silver has been in deficit for years, meaning the world consumes more than it produces. This is not a market swimming in abundance. This is a market tightening quietly beneath the surface. That is why industrial buyers are behaving differently. Samsung didn't go buy paper futures. They reportedly went directly to a mine and locked up years of production through direct deals. That is what sophisticated players do when they don't trust exchanges to deliver real metal. Governments are hoarding. Corporations are bypassing paper markets. Inventories are draining. Yet futures prices can still be smashed lower in hours through massive contract selling. That is the core insight. Paper can control the short-term price, but paper cannot create silver. Eventually, physical reality always wins. And that is why this crash may not be a bearish signal at all. It may be the opposite, a warning that the pricing mechanism itself is unstable. The paper market says silver is cheap. The physical market says silver is scarce. One of those is lying. History shows that when paper and physical split this far apart for this long, the truth always arrives the same way, not through headlines, but through shortages. So the real question is not whether silver crashed. The real question is whether January 30th was the first crack in a system that cannot hold much longer. Because if the physical market continues tightening while paper games continue suppressing price, the eventual reset could be violent. And when that happens, silver won't move gradually. It will snap, just like it did on the way down. Now I want to hear from you. Do you think this was pure market mechanics? Just leverage unwinding? Or do you believe something deeper is happening behind the scenes? Because to me, the most disturbing part isn't that silver crashed. It's that physical silver never followed. If silver is really worth $75, why can't you buy it in Dubai? Why is Shanghai still paying over $100? Why are inventories draining while paper volume explodes? One of those markets is lying, and historically, it's always the paper market that breaks first. I rate every comment, and I'll pin the sharpest analysis. If this breakdown helped you understand what's really happening, share it with someone who still thinks this was just a normal correction. Because the real story is never in the headlines, it's underneath. And here's the part you need to remember. January 30th was not the end. It was the warning shot. because the structural forces driving silver scarcity are still accelerating. Exports restricted, industrial demand rising, warehouses draining, premiums widening, paper contracts multiplying. The market may look calm today, but the fracture remains. And the next time physical demand collides with paper suppression, the snapback could be violent. So keep watching. Because what happens next in silver won't just affect traders. It could reshape the entire precious metal system and expose whether global pricing is real or just an illusion built on paper. This is the hidden economy, and the real story is never on the surface. I'll see you in the next one.